Now for ETF Spotlight, we're going to take a look at the banking sector. We've got earnings this morning from Bank of America, and you can see what the spider has been doing. Let's get over to Wilfred Frost for more on those earnings. Wilf.
Hi, David. Well, banks have, for the most part, delivered decent earnings so far this quarter. Bank of America, for example, today, as you mentioned, had their strongest net income number ever. EPS came in at 66 cents ahead of 62 cents estimate, and this was down to strong core performance in their retail bank. Loans up 3%, deposits up 4%, and credit quality remaining strong. Provisions fell $118 million to $716 million, well ahead of the consensus for $964 million. However, despite positive absolute loan growth, the number was a little behind consensus. If we look at the banks that have already reported, the sector-wide loan growth is looking at around 2%, which is underwhelming given the GDP and sentiment data we've had recently, as well as the tax cut at the start of the year. However, underwhelming loan growth has not been accompanied by falling credit quality, which does encourage the bulls out there. Over 2 days since the banks began reporting, JP Morgan has performed worse despite an EPS beat. Why is that? Well, their revenue, while up 5% year over year, fell 2% quarter over quarter. And they are the ones with the most premium valuation on a price to book multiple. But all of the banks do look cheap on the P multiple relative to the rest of the S&P 500. Going back to the spider, the XLF is down nearly 5% year to date. Guys?